Welcome back, I'm Richard Gonclaves. My guest today here on Market Moves is Roger Montgomery, joining us on a day where the share market fell. The S&P ASX 200 off by around about 0.7% or 33 points at 4,701. The All Lords 4707. Okay, let's take a look at the one stock actually which didn't see any volumes. That's the Ten Network. In a trading halt, Canwests saying that it sold its stake in Ten for $680 million. Macquarie Capital Advisors will broker the deal, with shares expected to be on-sold to institutional investors. Canwests has been struggling with $4 billion in debt and has been in negotiation with its bondholders for months. The latest extension on the debt is due to expire at the end of this month. The sale is expected to be completed by the beginning of October. No new shares will be issued as a result of the sale. Meanwhile, Ten has reaffirmed all previous earnings guidance, with EBITDA expected to come in at $151 million for the full year. It says the advertising market remains difficult, but costs have been reduced 2% on year. Interesting story, because Canwests has been trying to offload this stake for a while, but
I was offered some shares today.
Okay.
I got the call this morning. Do I want to take some shares up at $1.30? The trading halt was on at $1.37. It's nice to buy things from a distressed seller. You know, if somebody's in distress and they have to sell, that's usually a good thing. But on the flip side, you want to make sure you're getting good value. It's all very well taking advantage of a distressed seller, but you want to make sure you're buying something at cheaper than what it's worth.
Right.
The interesting thing about Channel 10 is its profits this year are not much higher than they were 10 years ago.
Okay.
They're a little bit high, but not a lot. And the return on equity is marginally better than it was a decade ago, but the company now has much more debt than it had 10 years ago. So you would expect that return on equity would be higher. It strikes me that 10 is just a mediocre business. You know, it's not a great business, and so on that front, it's not the sort of business that I would want to own. So when I got the call today, Rog, do you want to take some of Canwests shares in 10? My immediate response was no thanks.
Okay.
Now, what do we value it at? You know, that's the interesting thing, and I know I'm going to be, you know, dragged over the coals of this one. For this one, I think it's worth about 50 cents.
Right.
That's what I actually think it's worth. And, you know, that sounds absurd, but I can remember people saying, Rog, that was crazy when I thought Telstra was worth $2 and it was trading at $9. So look, 10 is just not a business because it's not earning a lot more than it was earning 10 years ago. If you and I were going to go into business and I said to you, Richard, well, in 10 years' time or 20 years' time, we're going to earn the same as what we're earning today.
Say no thank you.
You'd want to get a bargain price for that business. You want to get in as cheaply as you possibly could. Well, that would be less than 50 cents for Channel 10, and it's trading at $1.37, or it's on a trading halt, but $1.30.
So who is likely to be buying this? Because, and what I'm getting at is, does it make it a takeover target?
Well, you know, I wouldn't take it over at $1.37 if it's worth 40 cents or 50 cents.
Right.
Someone's I don't know. The shares. Well, people do buy the shares. Not everyone follows the market the way I do. Not everyone values the companies the same way I do, and they buy shares. And again, just because I value it at 50 and it's trading at $1.30 doesn't mean it won't go to $1.40 or $1.50, and some institutions who take the placement might make some money. But it's just not the game I play. You know, I try and buy things cheaper than what they're worth, and I'm not getting that opportunity here.
Let's talk about one other stock which was down by about 4%. That's David Jones. It delivered a solid full-year net profit, up 6.2% to $156.5 million, beating analyst expectations. The result is up from a $147.3 million result and is the best result since listing in 1995. Government stimulus payments helped the upmarket retailer, with designer fashion and cosmetics leading the charge. The Sydney-based group also reaffirmed its guidance for net profit growth of between 0 and 5% in fiscal 2010. Revenue for the year was down 5.3% to just under $2 billion from $2.1 billion in the prior year. DJs will pay a final dividend of 17 cents per share, up from 16 cents a year earlier. So profit number is pretty much a record. It's saying that, you know, the outlook hasn't changed. It's still expecting 0 to 5%. Why do you think its shares got slammed then?
Okay, a couple of things. You and I could open a bank account, put money in that bank account, earn interest. Next year, reinvest the interest, earn more interest. It would be more than the previous year's interest. We could announce record earnings every year, right? There's nothing special about record earnings. Between 2000, I've just got to have a look at my numbers here, but between 2003 and 2006, DJ's had no debt. Debt is rising significantly, or it has risen significantly compared to that period. Its profits are going up and its return on equity is going up, but it's being debt funded. More importantly, return on equity is now declining, or is forecast to decline over the next couple of years. So even though the profits are going up, the return on equity is dropping. Now, the way I value businesses, return on equity is a big input. And so if return on equity drops, then the valuation could be going down. In this case, it isn't. Valuations are going up. So over the next couple of years, it'll be higher, but only a couple of % higher than where it is today. And the valuation I've got is about $3.70 a share. It's trading at $5.44. So again, not cheap. Now, the result was as expected. So in terms of today's reaction, one would say that it's, buy the rumour, sell the fact, and the market sort of said, well, there's the result. It wasn't. We were buying in anticipation of maybe the company being a bit conservative, but it's coming exactly at what we thought it would, and so it's not that great. For me, it's way over what it's actually worth if I'm going to try and get a bargain. The growth that we're seeing is being funded more by debt than anything else in terms of its capital structure. There's a lot more debt than there was before, and the value is a lot lower than the price. So for me, I'm going to stick to JB Hi-Fi.
Okay, but what about when Myer comes into the play? Because if I'm not wrong, its prospectus is issued next month. Is it something you'll be looking at?
I've asked. My wife is a Myer One card holder, so we filled out the application form to reserve a copy or whatever it was. I said to get a copy of the prospectus. It'll be really interesting. I think I said to you that it was worth, or last time I was on, I think I thought it was worth somewhere between 1.7, 2.3 billion dollars. That's what it's worth. But really, long term, I think the value of Myer isn't going to go up. It's not going to skyrocket, and really you'd like to buy businesses whose value rises by a really good clip over a long period of time. I don't think that's going to happen. If I can get it at a bargain price, there might be an opportunity to make some money. But I don't think, I think the timing of this sale, is to take advantage of the rally that we've seen in the stock market. And
in the retailers also, or most of the retailers.
Exactly, and generally, floats, there's no bargains in floats. They're being timed to maximise the sale price for the vendor, and that's a rational thing to do. So you'd need to be looking very, very closely at this one. If the market cap when it comes on, the price that's being offered is more than $2.3 billion or $2.4 billion, there's not a lot in it.
Small cap star is when we ask the brokers to take a look at the smaller end of the market to identify any opportunities. What are you looking at there?
Well, again, I'll come back to Macmillan Shakespeare. It's just a terrific business. It has absolutely no debt to speak of, which is just fantastic. It's got extraordinary return on equity and its cash flow is amazing.
What does it do for those investors that don't know? Because it's like I said, it's a smaller stock.
It's a salary packaging company. So, you're a company, you've got a whole bunch of staff, you want to package up a car and all that. They do all of that administration, and they do it very, very well. You can imagine that type of business doesn't have a lot of plant and machinery that it needs to reinvest in. So it has a lot of what I like to refer to as uninhibited earnings that aren't required to be reinvested back in the company to maintain. It's the opposite of Qantas.
Okay.
It doesn't have a lot of infrastructure and plant and machinery and stuff that needs to be maintained and replaced. It's basically got some desks and some computers and some IP. And that money doesn't need to be pumped back into that. And so a lot of the cash flow gets to come out and can be redistributed either by way of buybacks or through dividends and the like. It's trading at a significant discount to my estimate of value. Now, most of the times you ask me a question, Richard, about a company, and I'll tell you, its price is nowhere near what it's worth. It's way too expensive. This is one where it's the opposite. Its price, and I'll just pick it up here.
Right.
I've got it trading at $3.53 and a valuation of $4.45 for 2010. Not much change in the valuation between 2010 and 2011, but it's generating a 50% return on its equity, and it has absolutely no borrowings. So there's no red bars there. That's a good sign.
Okay.
That's a company with no debt.
All right, there you go. That's our small cap style for today.